Somebody said once upon a time that there are two certainties in life: death and taxes. The challenge is that as people, we don't really like paying tax. Now, we're all working really hard to achieve whatever we want to achieve, but what are we doing fundamentally? We're building value. And what is that value measured in? Well, it could be measured in assets. It could be measured in life experiences that we have. It could be measured in the fact that we have children. His Majesty's Revenue and Customs turns around and says, okay, we're going to tax those now. You're going to have to pay inheritance tax on that. But ultimately, inheritance tax might be payable upon death on the value of the assets that you hold. Now, why is that kind of important? Because sadly, you'd have passed away, but your estate has to be taxed and valued. It might be that you pay no tax, but it might be that you suddenly find you have an estate of £1.5 million and you find that tax is payable on £500,000 at 40% today. That's quite a big number. And more importantly, what you might not know is what the person that built up that value, what they wanted you to do with those assets. But the people that are left with it are not just left with the emotion of the fact you're no longer there, but they understand what your wishes are and then act to make those wishes happen. And then there are things that we could do during our lifetime that may or may not mean that tax is payable. We can gift some things. What you don't really want to do is gift assets, because gifting assets can mean that there's going to be things like capital gains tax. But if we gift an asset, we are basically trying to say, look, for a period of time, I need to survive, because then that drops out of my estate. At the moment, that's 7 years. In the future, who knows what that might be. But there is that rule that has to be the case. You can give gifts of small amounts of cash, up to about £3,000. But if you give a gift out of income, that is never ever going to fall into the inheritance tax rules. So if you end up with excess income, certainly towards you get the end of your working life, that might be the case, because children might have left home. You're not having that same burden. You're not then also having to worry about a mortgage. Hopefully you're able to go away and enjoy life, go on holidays, go and experience other things. But you can then make gifts of income, probably to children, that are not only going to help them at the point of which they probably really need it, but are also going to transfer value without a tax payment being needed. And that becomes really important. The other thing to consider in all of this stuff about having a discussion is a power of attorney. And I can't stress how important a power of attorney is, irrespective of your age. So a power of attorney is a really strong document that allows an individual to protect your interest at a point of which you're unable to protect your interest. And that forms into two bits. There is a financial piece and there is a medical piece. The medical piece is probably the more straightforward of the two, in that it's saying that if you became incapacitated, they can make decisions about whether or not, for instance, care should be continued, what that care should look like, how that should happen, without doctors having to make that decision based on their criteria, not on your understanding of the person that you are acting for. The other, obviously, power of attorney is a financial power of attorney. And a financial power of attorney allows somebody to effectively access a bank account and effectively stand in your stead in writing a check or something out of your bank account. What I want to stress at that point is a financial power of attorney, all it does is allow that person to protect your estate, not take your estate out of the bank account and put it into their bank account for their benefit. That's not what a financial power of attorney is about. It is about an individual being able to protect your estate in the right way at a point in time. If they decided to go into the bank account using that power of attorney and withdrawing significant amount of money, that would potentially be fraud. But having those frank discussions early and in full enables everybody to become comfortable with those things at the earliest opportunity, as opposed to waiting until the worst has happened. And sometimes those things can't be put in place. If somebody becomes incapacitated, you can't go and sign a power of attorney document. It doesn't exist. It doesn't work. It would fail. So all I really want to say is make sure you have discussions early, even involve an accountant, involve a lawyer, involve somebody that you trust to enable you to help shape those discussions over a period of time before coming down to, right, this is what I want to do. Because ultimately, that will allow the value to pass down in the way that you want it to pass down, and your wishes to be preserved in the way that you want them preserved, rather than somebody else making the decision. So my name's Martin Cavey. I'm from Chorus Accounting. Please follow the YouTube channel, give us a like, a say, whatever it wants to be, and come back soon.